Hi, my name is Rajiv Rebello and I'm the principal and actuary of Colva Insurance Services. This is the fourth video in our series of how choosing the wrong life insurance policy can be a $21,000 mistake. Oftentimes people are unsure whether they should get life insurance for 10 years, 20 years, 30 years, or more. In this video I'll be highlighting the importance of properly choosing a policy for the right time period that properly matches your needs. I'll walk you through a numerical example to illustrate how choosing a policy for the wrong amount of time can result in you spending thousands more in premiums than you really needed to. So let's go ahead and take a closer look at how policyholders lose thousands by purchasing a policy that doesn't quite match their needs, only to cancel it a few years later. We're going to do this by taking a look at a 35-year-old father who's interested in purchasing $1 million worth of coverage, but is unsure whether to get it for 10 years, 20 years, or 30 years. The first table on the slide shows different policy options for our 35-year-old father, who again is looking for $1 million worth of coverage. He can choose either the 10-year term policy, the 20-year term policy, or the 30-year term policy. The average yearly premium column indicates the average yearly premium for each of these products. So we can see that for the 10-year term product, the yearly premium is $235 a year for 10 years. For the 20-year term product, it's $435 a year for 20 years. And finally, for the 30-year term product, it's $795 a year for 30 years. The next column over shows the total premium paid after 10 years for each of these products. So we can see that for the 10-year term product, after 10 years the policyholder would have spent a little more than $2,300 if he chooses this product. If he chooses a 20-year term product, he would spend a little more than $4,300. And finally, if he chooses the 30-year term product, after 10 years he would have spent almost $8,000 on premiums for his life insurance coverage. So one of the first things you should notice here is there's a vast amount of difference in premiums and cost between the 10-year term product and the corresponding 30-year term product. And this makes sense because there's a higher chance of this 35-year-old dying within the first 30 years or before he's age 65 than there is before he's age 45 or within the first 10 years. And hence, the life insurance company charges the policyholder different amounts of premiums accordingly. The next two columns over show a similar analysis after 20 years of owning each of these products and after 30 years of owning each of these products. So with the cost of these different policies being so different, the question that everyone should be asking is, well, if I purchase a 30-year term policy, how much will I end up losing if I end up keeping it for a shorter term, for example, for only 10 years or for 20 years? We can help answer that question in the second table at the bottom. We're going to assume that the policyholder went ahead and purchased a 30-year term policy, and we're going to see the effects of that if he ends up canceling it early. So we can see here in this column that we're going to evaluate the financial impact after 10 years, 20 years, and 30 years. Again, the average yearly premium for the 30-year term product is $795 a year. Whether he keeps that policy for 10 years, 20 years, or 30 years, he's still paying $795 each year. The next column over shows the total premium paid after each period. So for example, after 10 years, he's paid almost $8,000 for the 30-year term product. After 20 years, he's paid almost $16,000. And finally, after 30 years, he's paid almost $24,000 for the product. The next column over is what's called the minimum premium for the coverage. In other words, what is the minimum premium he could have paid to receive the same amount of coverage for this amount of time? So for example, we see that for the 10 years, he's paid $8,000 almost for the 30-year term product. But he could have just as easily bought the 10-year term product, and that would have only cost him, as we saw above in the previous table, a little more than $2,300. The next column over shows the loss. In other words, if this individual would have purchased the minimum premium coverage, how much would he have saved as opposed to what he did by purchasing the 30-year term product? So for example, if this individual ends up purchasing the 30-year term product at $795 a year, which costs almost $8,000 for 10 years, but then ends up canceling it, he would have lost almost $6,000 because he would have been better off if he just purchased the 10-year term product for $235 a year and only paid $2,350. Similarly, if he would have just purchased the 20-year term product and kept it for 20 years as opposed to buying the 30-year term product and canceling it after 20 years, he would have lost a little more than $7,000. We can see that the difference between the total premium paid after each period and the minimum premium for each period increases as the years get older. In fact, you only receive the full benefit of the 30-year term period if you end up keeping it for the full 30 years. Unfortunately, very few people end up keeping this 30-year term product for the full 30 years. In fact, greater than 50% will end up canceling it after 10 years and end up losing anywhere from $0 to almost $6,000. In fact, less than 10% will end up keeping the policy for the full 30 years. And this is, of course, how life insurance companies design their products and build their business model around, such that some people get a very poor deal by buying an expensive policy and canceling it early, and some people get a great deal by buying an expensive policy and keeping it for the very end. And just to re-emphasize this importance of purchasing a policy that better matches your needs, as opposed to just purchasing an expensive one and canceling it early, I've included the same table here, except added an additional column, which shows the percent of people who cancel the policy after each period. So again, as I mentioned before, for this 30-year term product, nearly 56% will end up canceling after 10 years. 78% will end up canceling it after 20 years, and less than 10% will end up keeping the policy for the full 30 years. What this means is, again, that very few people are getting the full benefit of the policy, and most people are in fact losing thousands of dollars by purchasing a policy that doesn't quite match their needs, only to cancel it a few years later. Well, that concludes the fourth video in our 6-part series of how choosing the wrong life insurance policy can be a $21,000 mistake. In the next video, we'll use a numerical example to illustrate in which cases you should buy a permanent policy for your long-term needs, and in which cases you're better off buying a term policy and investing the difference in premium costs elsewhere. You can find a summary and links to all 6 videos in the series in the YouTube description below this video.